Last week we received our CPI number. It came in at 7.7%, which was roughly 20 basis points below expectations of 7.9%. We are trending lower from 9.1%, and if we have reached the peak in inflation and it continues to roll over, the question is, what type of business would we like to be invested in? Ideally, interest rate proxies. They could include staples, they could include utilities, they could include REITs, they could include MLPs. These are all interest rate sensitive assets. And if we've reached a peak, it might be a good time to start considering some different companies in those different sectors. But the question is, what would be our expected valuation? In today's video, we're going to better understand the Gordon-Groth model. The Gordon-Groth model is essentially a dividend discount model that comes up with an expected value of a company based on a couple of inputs. It's a very simple model, and it could give you a little bit of perspective as to whether a company is overvalued and undervalued. We've got two examples, and in those practical examples, one company is overvalued and the other company is undervalued. So without wasting any more time, let's get straight into it. Okay, this is very simple, and we're going to break it down so that a toddler would be able to understand this. It's important to note before we get into it that every valuation model is not perfect for every single company. And this is a classic example. The Gordon-Groth model is a discount dividend model. And so if you have a company that's high growth, not displaying any net income, and doesn't have any dividends being paid out, it's not going to be a great company to use the Gordon-Groth model. It's not really going to give you a consistent sort of expectation moving forward. However, if you have a company maybe in staples, maybe it's a utility, MLP, REIT, for argument's sake, it might be more consistent. So this model will work for companies that have more consistency in terms of those dividend payouts and the expected perpetual growth rate long term, maybe a long-term history of paying out dividends. So how we're going to break today's video down is we're going to first understand the model, the Gordon-Groth model, the formula that's essentially breaks down an expected valuation. Then we're going to consider what it's useful for. And then we're going to go over the capital asset pricing model, which is an input. And we're going to look at two different examples using a REIT and a MLP. So let's start off here at the top left. Gordon-Groth model, dividend discount model. V, the value of the stock, equals D1, which is next fiscal year's dividend. It's the expected dividends for next year, divided by the cost of equity, or the cost of equity. Now, if you guys watched the video, the weighted average cost of capital asset pricing model and the cost of equity is also an input there. So we're going to revise over that. We're going to calculate the cost of equity for the two examples that we have, an MLP and a REIT. And then finally, the perpetual growth rate. At what rate is this dividend going to grow in perpetuity? Once we have all that data, it'll give us an expected value, and it'll give us an idea of whether a company is undervalued or overvalued and a potential target, something to consider. What's it useful for, and what are actually some of the drawbacks, which I don't have mentioned here, which are very important? So what it's useful for is valuating companies that are consistent dividend payers. They're more mature businesses, maybe non-discretionary revenue. So for argument's sake, companies operating in the staple sector, companies operating in utilities, or structures like MLPs or REITs. Why? Well, an MLP is what's known as a master limited partnership, and this is what's known as a pass-through entity. The tax is passed on to the investor. And in order to have this sort of structure, a lot of the income of the business needs to be pushed out the door to investors via dividends. And instead of paying corporate tax, the person that's receiving the dividend pays income tax. Now, I think you receive a K1 file in the United States, a filing K1, and you could write a lot of that dividend off. But the dividend's very consistent and it's very high. And so an MLP might work really, really, really well in the Gordon-Groth model. As well as that, REITs, real estate investment trusts. Why? In order to keep a status as a REIT, the REIT itself must distribute at least 90% of their taxable income to shareholders as dividends. So dividends are consistent and they're longer term in nature. So both REITs, MLPs, staples, utilities, these type of companies, when you're analyzing them, let's say you've gone over the balance sheet, cash flow statements, income statements, you've really understood everything about these companies, good quality, profitable businesses. Now you need to understand what a fair value is. These type of businesses and these type of industries tend to work really well with the Gordon-Groth model. What's some of the drawbacks? Well, as you can see here, G is the perpetual growth rate. Nothing lasts in perpetuity. So that's That's the fail rate here for this model. It may be very consistent in determining what a valuation is over the next couple of years, but that may not be fair over the next decade or 2 decades, as the perpetual growth rate is likely incorrect. It could be higher or lower depending on circumstances. And it's way too hard to sort of discount 10, 20 years into the future. Next couple of years might be a lot easier, but the next 10 or 20 years could be very difficult. So let's go through an example. We're going to look at a REIT, we're going to look at Medical Properties Trust, and we're going to look at an MLP, Energy Transfer. And we're going to determine a valuation using this model to better understand whether we should be buying or selling. This is not investment advice, this is purely an example. As you can see in the top right here, we're going to need some input into this model in order to get our expected value. So capital asset pricing model, let's revise over what this is. It's the risk-free rate minus the equity risk premium multiplied by beta, so it's adjusted for beta. Risk-free rate. There's very few things in this world that are risk-free. We would normally look at the US 10-year bond yield. The idea is that it's guaranteed by the US government, and the US government hasn't gone bankrupt for the last 100 years, so therefore it's risk-free. That being said, the next 100 years might be very different. So just take that with a pinch of salt. We normally use the 10-year bond yield. It's roughly 4.5%. Or it was a couple of days ago. We're just going to use that for this example as of right now. Equity risk premium is usually the premium above the risk-free rate that equities generate. So long term, if you reinvested the dividend, the S&P 500 has generated roughly 10.1% over the past 100 years. If you remove that dividend, the equity risk premium above the risk-free rate is roughly 5.6%. And that's usually what I use. And then we multiply it by beta, the volatility of the individual asset. If you guys are interested to understand beta a little bit more, or CAPM, you can check out the videos on WACC, weighted average cost of capital, and you can check out the video on beta. There's 2 individual videos that will break both of those down in a little bit more detail. In this example, Energy Transfer, 4.5% is the US 10-year bond yield, 5.6% is the equity risk premium, multiplied by 1.77, which is beta, and that gives us a cost of equity of 14.41%. When we're looking at Medical Properties Trust, 4.5 plus 5.6 multiplied by 0.85 gives us 4.97%. So let's build out this calculation and let's understand what valuation the Gordon Growth model would place on both of these different companies. So let's start off at the top here. We're going to look at Medical Properties Trust. We have V, which is the expected value, which I've put over here. And on the top, we want dividend for the first fiscal year moving forward. So dividend 1 year forward. In this case, it's 1.2. I'll show you where I got that in just a moment. And that's divided by, or, which is the cost of equity, which we calculated right here, 4.97% minus the perpetual growth rate. Again, we'll look at that in just a moment where I got 2.1%. And that gives us a price of $41.81. $41.81. As of right now, it's trading at $12.55. However, it's important to note where we currently are. We've had interest rates rise at a pretty historic rate, and REITs, which are a proxy for interest rates, have fallen off a cliff. So maybe right now might not be a bad idea to start considering some REITs. So where did we get this information? We got the information from Ticker Terminal. I do have a link in the description below. Ticker Terminal is a fabulous resource, got all the information you need for all of these calculations. It's everything in one place, it's fantastic. So we're going to key in our ticker, MPW, Medical Properties Trust. And what we're going to do is we're going to pop on over to estimates. In estimates, what we have here is, if I zoom out a little bit, we've got 15 years of data, 17 years of data back to 2005, up to the present day for dividends, and we've got estimates over the next 5 years forward. The data that Ticker Terminal uses plugged into Capital IQ, which is from SPGI, Standard & Poor's. So what we're looking for is the estimated dividend for next year, D1. So if I scroll all the way up here, we want to have a look at 2023's dividend. So if we go through all of this, we scroll down, you can see dividend right here, 2023, $1.20. That's where I got the dividend 1 year forward. Another input piece of that data is the growth rate of that dividend. Now the growth rate, I could make an estimate myself. However, there's a number of full-time analysts looking at MPW consistently day in, day out that will probably make a better guess than I would. So what I'm going to do is look at the estimates from 2023 into 2026 and have a look at the compounded growth rate. So dividends per share are expected to grow at 2.1% compounded over the next 4 years. It's about as good as a guess that I could give. So I'm going to use 2.1% in order to understand what the perpetual growth rate is for MPW. And as you can see, without a huge amount of effort, it spits out a target for us, 41.81. Now, whether that's significant or not, it doesn't really matter. What it tells us is that this company, according to the growth model, the Gordon growth model, is incredibly cheap relative to today's price of $12.55. And as long as all our T's are crossed and our I's are dotted, this could be a fabulous opportunity, but it's very important that we do deeper analysis. When we're looking at Energy Transfer is an MLP. It's a midstream operator. They transport oil and gas. It's an industry that's been on fire over the past 1-2 years. And so look at the outcome here. REITs got crushed with higher interest rates. And what we're seeing here from Energy Transfer, it's been doing very well over the past couple of years. So when we input that data, 1.22, $1.22 is the dividend for next year expected. We've got a much higher cost of equity because it's got a higher volatility based on its beta. And when we minus that away from the 1.9% perpetual growth rate of the dividend, we end up with $9.75, suggesting that the company is overvalued, trading above $12 per share. So what the Gordon growth model can do for us is we can understand whether a company is trading at a discount relative to its expected cash flow in terms of dividends for the investor or not. And again, provided that all the T's are crossed and all the I's are dotted, this could be a good investment to look a little bit deeper into. The Gordon growth model can help us set our expectations over the next couple of years. If you're interested, we also cover a breakdown of all 3 financial statements. We look at profitability metrics and efficiency metrics for businesses. Thank you very much for your support and have a great day.